Today, we're going to demystify a tax form that, let's be honest, most people only run into during a pretty tough time. I'm talking about IRS Form 1041. Now, this isn't your everyday 1040. This is the tax return for estates and trusts, and it's absolutely critical for wrapping up a person's financial life.
It's a heavy question, for sure, but also a really practical one. When someone passes away, their financial world doesn't just stop. Stocks can still pay dividends, rental properties might still collect rent, and of course, debts still need to be paid. So how does the IRS keep track of all this activity? Well, the answer is pretty interesting. They treat the person's remaining assets as a whole new temporary entity.
So here's our game plan for today. First, we'll look at what I'm calling the afterlife tax return. Then, we'll get into the basics of estates and trusts. After that, we'll cover the super important $600 filing rule. We'll also touch on why not all trusts are created equal, and we'll wrap it all up with the fiduciary's final word.
Okay, let's start at square one. What is this form actually for? What's its purpose? Well, it all kicks off the moment someone passes away, because at that very moment, a brand new legal entity springs into existence.
This is the key thing to wrap your head around. A decedent's estate isn't just a pile of stuff. To the IRS, it's a completely separate entity. You can almost think of it like a temporary pop-up company that holds all of the person's property, bank accounts, real estate, you name it, until it can all be properly sorted out and passed on.
And that is exactly what Form 1041 is for. It's the official income tax return for that new pop-up company. It reports any income the assets have generated, like interest from a savings account, it lists any deductions or losses, and, most importantly, it tracks whether that income is being held onto or passed out to the heirs, because that determines who's actually on the hook for the tax bill.
Now, you'll hear that Form 1041 is for both estates and trusts, and while they're similar, they have some really important differences. It's also crucial to know who's in the driver's seat managing all of this.
So what's the difference? It really comes down to timing and intent. An estate is reactive, it just happens, automatically, at death, to handle the final cleanup. A trust, on the other hand, is proactive. It's something you set up on purpose, either while you're alive or in your will, specifically to protect and manage assets for your beneficiaries. But, and this is the important part, both of them use Form 1041 to report their income.
And that brings us to a huge concept. Both estates and trusts are generally considered pass-through entities. This is so important. It basically means the estate or trust itself usually doesn't pay the final income tax. Instead, that income and the tax that goes with it is passed through to the beneficiaries who get the money.
So who is the person actually doing all this? Filing the 1041, managing the money? That person has a special legal name, the fiduciary. It's just a formal term for the person or maybe even an institution, like a bank, that has the legal duty to act in the best interest of the estate or trust. For an estate, you'd call them the executor. For a trust, they're the trustee. The fiduciary's job is pretty much being the short-term CEO of the estate. They have three core duties. First, they have to gather up all the assets. Then, they use that money to pay off all the final bills, taxes, and any other debts. And finally, whatever's left over gets distributed to the rightful heirs or beneficiaries, all according to the instructions in the will or the trust. Okay, this is the big one, the practical question. Does every single estate or trust have to file this form? Nope. So, when does the IRS actually make you file a Form 1041? It all boils down to a pretty simple income number.
And there it is, $600. For most domestic estates and trusts, if there's gross income of $600 or more for the year, you've got to file. It's a surprisingly low number, right? That means even a tiny bit of interest from a savings account could be enough to trigger that filing requirement. Oh, and you also have to file no matter what if one of the beneficiaries is a non-resident alien.
Of course, there are always a few exceptions. One of the main ones has to do with an individual's bankruptcy estate. For a Chapter 7 or 11 case, the filing threshold is way higher. We're talking a gross income of $14,600 for the 2024 tax year.
All right, now while tons of trusts file Form 1041, there's a very, very common type that doesn't. And this is also the perfect time to drop in a pretty serious warning from the IRS about how trusts can sometimes be misused.
This is the big exception you'll see all the time, the grantor trust. The most common example of this is a revocable living trust. See, because the person who created a trust, the grantor, can still change it or even cancel it whenever they want,
The IRS basically just pretends the trust doesn't exist for income tax purposes. All the income and deductions, they go right onto the grantor's personal Form 1040, not a Form 1041.
And now for that word of warning, and I'm pulling this quote directly from the IRS Instructions. The IRS is really cracking down on what they call abusive trust arrangements. Basically, these are shady schemes that aren't about legit estate planning, they're about illegally hiding assets and dodging taxes.
So here are the red flags to look out for. If you hear a promoter promising that a trust can completely eliminate your income tax, or that it'll let you deduct personal expenses like your home mortgage, or that it can hide who really owns your assets, you should be extremely careful. These are the classic signs of an illegal scheme, and getting involved can lead to some really serious penalties.
All right, let's bring this all home. We've gone over what Form 1041 is, who has to use it, and when it's required. So let's just quickly recap the absolute most important points.
Here are the 4 pillars of what we've talked about. Form 1041, it's the income tax return for these special entities. The fiduciary, that's the person legally in charge. Pass-through. Remember, the income usually flows to the beneficiaries, and so does the tax bill. And the filing trigger, that low gross income number of just $600.
You know, at the end of the day, it might just seem like another complicated tax form, but Form 1041 is really about closure. It is the final, formal accounting of a person's entire financial story. It's about making sure every I is dotted and every T is crossed before those assets are passed on to the next generation.
And that really leaves us with a final thought. Understanding this form isn't just for people who are currently executors or trustees. It's for anyone who's planning for the future. A really well-thought-out estate plan with clear documents and organized finances can make the fiduciary's job and this final conversation with the IRS so much simpler. So I guess the question is, how simple will that final chapter be for your loved ones?